Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. At a previous question, I was asked about asset allocation of my portfolio, which I will share at the end. But let's talk about what asset allocation is. Asset allocation is how a portfolio is divided between stocks, bonds, and other assets, as well as the types of stocks. The most important factor in a portfolio return is the asset allocation. You can think of it as the ingredients of the recipe to achieve your goals. So you do need to establish a target asset allocation of cash, fixed income, and equities to meet your investment mandate and to meet your investment objectives. You basically need to match the portfolio to yourself. So you can look at it from basically 3 perspectives. The first is the risk profile. That is your ability to handle volatility, which is the up and down movement of the investment value. A risk profile has 2 components. One is the risk tolerance, which is, are you able to handle the risk psychologically? Are you going to freak out if you see a statement with losses and then you can't sleep at night? The second part of the risk profile is risk capacity. Are you able to handle the ups and downs financially? Are you selling assets that just dropped in order to buy groceries? Do you have other sources of income and be able to handle a downturn? And please note that financial education increases the amount of risk a person is able to handle because they know what is happening. The second part of your risk allocation will be the time frame when you need the money back. Whether it's all of the money or some of the money, it's important to know when the money needs to come back. And the third part is the return that you need. Do you need a 5% return or do you need a 20% return per year? It's going to be very different sorts of investments depending on that number. And your financial advisor, if you have one, would be doing a know your client or a KYC that would determine your risk profile, and they would also find out your time frame for the investment and the return that you need. And so the risk profile, the time frame, and the return needed is what drives what portfolio you choose. Now, volatility and return are correlated. So if you need a large return to meet your goals, you will have to stomach more ups and downs rather than if you need a small percentage return. The time frame is important because if you need the money back soon, you can't have the money in something risky. You could get unlucky and need to pull the money out after a pullback in the stock price. Stocks need at least 5 years, preferably 10, and as the time nears, you need to rotate out of stocks and into something safer. Stocks are generally more volatile than other assets, with closer to home stocks thought to be less volatile. So the sequence from least volatile to most volatile would be Canadian stocks, then US stocks, followed by international stocks, and those are increasing in volatility. Of course, people just feel safer with things that they know and recognize the names and just things closer to home. International stocks, if they're in Europe, are probably no more volatile than what you would see in Canada. If they are in emerging markets, then yes, there could be additional volatility. Larger companies and their stocks are less volatile than small company stocks. So there is less upside and downside with larger companies, while a small stock could go ballistic and return you times 10 in a year, or they could go bankrupt. Bonds, which are loans rather than investments, are generally less volatile than stocks. Once you decided on what your portfolio will be composed of based on your risk profile, the time frame, and the return that you need, you'll have something like a 60% stocks and 40% bonds. And then what you need to do every 6 to 12 months is to see if the portfolio is out of balance and if it's no longer 60-40, and then you need to rebalance it back to your risk profile. And so what you would do is you would sell off what went up disproportionately, and you would buy what went up less. This is all about percentages, so both components in my example could have gone down, or one could have gone up and the other one could have gone down. If you're out of balance by a certain amount, you would want to rebalance. So let's look at my own asset allocation. Keep in mind this works for me and it's not intended for anyone else, so please make sure whatever you choose works for you. So I've divided things into 5 broad categories without getting into single stock details. But the first one is my biggest as a percentage. So they're single stocks, Canadian dividend payers. They're tax efficient in my non-registered accounts. They're almost 2.4 million. And they are almost 44% of my total net worth. And they would be things that pay a dividend, and they're averaging 4% yield or more per year. And this is what I use for my everyday spending and for my groceries. The next big category is single stock US growth stocks. So around 361,000, 6.6 of the portfolio, and they are intended for growth. Generally, there is no dividends, or at least I'm not targeting dividends. If I find a good stock that I like and it's paying dividends, I'm not going to say no. But these are intended for growth. Next, I have growth mutual funds, just over 1.1 million, 21% of my net worth. And just a quick note, these are intended for growth, but they're actively managed mutual funds. 216,000 of this is in balanced funds. And balanced funds means that there's a bond component. So about 20% of the mutual funds have some sort of a bond component, and usually the bond is 30 or 40% of the fund itself. About 1.3 million is in real estate. This includes my primary residence condo and then 2 U.S. investment properties, one of which I'm actively trying to sell right now. They're both in Las Vegas. And last but not least, for a little bit of risky diversification, and about 4.4% of my portfolio is private equity, which are investments in private companies. And I would never suggest for anybody to have more than 5, at most 10% of their portfolio in private equity, because it is risky, and I've had a couple of them go bad. So I hope this answers the question of what my asset allocation is, and I hope I also enlightened you a little bit about what asset allocation is and have given you a better idea how to use your financial goals and constraints to better choose your portfolio. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.